Look at what Ukraine choosing to hit when it reaches deep into Russia. This is not about making petrol expensive for ordinary people. This is about turning Russia's main war cash machine into a system that constantly leaks time, money, and confidence. Oil for Kremlin is not just commodity. It is tax base, hard currency inflow, payroll for soldiers, and subsidies that keep regions quiet. When that flow becomes shaky, everything else becomes harder. Ukraine's method is precise. Pumping crude is only the first step. Money appears when crude is processed, blended, stored, shipped, insured, and paid for. So pressure goes on the middle of chain, key refinery units, storage depots, export terminals, and the nodes that connect barrels to buyers. In mid-November, a drone attack forced Russia's Black Sea export hub at Novorossiysk to suspend oil exports for a time, and pipeline flows were reportedly paused into that outlet. In early December, a major refinery on the Volga had to halt processing after a drone strike damaged critical equipment. And on December 12th, Ukrainian security officials said drones struck two Russian oil rigs in the Caspian Sea, a signal that even offshore infrastructure no longer feels distant or safe. Russia also reported a very large wave of drones around December 10th to 11th, including toward Moscow, which tells you this campaign is sustained, not occasional. Alongside the airstrikes, Ukraine has been expanding pressure at sea, targeting the shadowy logistics that move sanctioned barrels and forcing Russia to spend more on port defenses, barriers, and patrols just to keep ships moving. Now, many people hear this and they say, but Russia still pumping, Russia still exporting. Yes, and that is exactly why the campaign matters. Russia has been coping by shifting throughput between plants and by using spare refining capacity to offset damage. Officially, the Energy Ministry has said it expects 2025 refining broadly flat versus 2024, despite repeated attacks. Industry reporting has described overall processing down only a few percent for the year, even though at peak periods between late summer and early autumn, roughly a fifth of refinery capacity was offline from a mix of strikes and scheduled maintenance. This sounds like proof the strikes fail, but it is opposite. It shows Russia burning its cushion. It shows the system running hotter, with less slack, with more emergency repairs, more rerouting, more protection costs, and more chances for one hit to create weeks of friction. Here is the mechanism in plain language. When a refinery unit goes down, you do not only lose export products. You create domestic fuel stress the state must manage. You shift supply by rail and pipeline. You pull inventories forward. You squeeze refineries that were already in maintenance cycle. You rush repairs with whatever parts you can source under sanctions pressure, and you accept more accidents and inefficiencies. Even when output recovers, economics often worsens because every extra day offline is lost margin, and every workaround adds cost. It is like an overpressurized pipeline with a relief valve. You can keep flow for a while by raising pressure elsewhere after one segment is damaged, but the stress just moves and the probability of a larger rupture grows. That is why these strikes are not one-off headlines. They are designed to accumulate damage in the only way that matters, through repeated disruption that turns reliability into a luxury. Refineries are strategic because war runs on diesel, jet fuel, and lubricants, not on crude sitting in ground. If you interrupt refining, the army feels it, but also the civilian economy, because trucking, agriculture, and heating all depend on fuel. The state then faces unpleasant choice: allow prices to spike and anger population, or impose controls and subsidize the gap, which drains budget anyway. And when export terminals or key pipelines are disrupted, barrels do not disappear, they pile up. That ties up ships and storage, forces discounts to clear the backlog, and reduces the tax take even if production number looks unchanged. Russia can reroute some flows via other ports, Baltic or Far Eastern routes, but each reroute means longer voyages, more insurance risk, more demurrage costs, and more exposure for the aging shadow fleet. So every strike is both physical damage and financial friction, like sand thrown into gearbox. And none of this even counts the security bill, air defense missiles, radar coverage, guards, and hardened facilities, which is pure cost with zero new value. Now, how does this translate into macroeconomy? The clearest signal is not how many barrels Russia pumps. It is how much money the state actually collects. In November, the International Energy Agency reported that Russia's revenues from crude and refined product exports fell to about $10.97 billion, the lowest level since the invasion began. Total oil and fuel exports were estimated around 6.9 million barrels per day, roughly 400,000 barrels per day less than month before. Urals crude, the main export grade, was assessed around $43.52 per barrel, down sharply month on month. Seaborne flows through the Black Sea were reported to fall by roughly 40% to about 910,000 barrels per day, a drop linked to the growing risk picture around vessels and facilities, and to buyers reassessing compliance and disruption risk. On the production side, the same tracking showed Russia's output in November around 9.03 million barrels per day, below October and meaningfully under its OPEC Plus quota. These numbers matter because they translate into budget stress with no good solutions. December is where the squeeze becomes visible in state accounts. Based on current prices and exchange rate, Russia's oil and gas revenues for December are projected around 410 billion rubles, roughly $5.17 billion, nearly half of what was collected a year earlier and the weakest monthly level since August 2020. For the full year, oil and gas income is projected around 8.44 trillion rubles, below the finance ministry's earlier plan of 8.65 trillion. This is driven by two forces that reinforce each other. One is weaker crude price, with the tax-relevant oil price in November around $44.87 per barrel. The second is stronger ruble, around 80.35 per dollar in late November pricing windows, which means fewer rubles per dollar earned. This is the ruble trap. A stronger currency looks like stability, but for an export state it can be fiscal poison. Meanwhile, defense and security spending remains elevated, and deficits must be financed. Analysts following the budget expect a large December deficit, on order of trillions of rubles, likely funded by issuing state bonds and by leaning on reserves if bond market absorption becomes difficult. Now add the sanctions chess. The European Union and the G7 have been discussing moving beyond the current price cap system toward a broader ban on maritime services used to move Russian oil, potentially as part of an early 2026 sanctions package. Shipping states inside EU have already warned about collateral impact on legitimate maritime business. But for Russia, the implication is clear. Less access to Western shipping and insurance, more reliance on opaque tankers, higher costs per voyage, and more accidents and enforcement risk. Even if Russia keeps selling to big buyers like China and India, the discount tends to widen when the logistics become harder and the state collects less when the trade becomes more clandestine. This is why Ukraine striking oil infrastructure and the West tightening shipping rules can work together like a vice. One side breaks hardware, the other side raises the cost of moving what remains. To understand why the budget feels this so fast, remember how the state captures oil money. It is not only profits of companies, it is taxes and duties that scale with price and are converted into rubles. So, when crude weakens and the ruble strengthens at the same time, the treasury gets hit twice. And because a large chunk of spending is now security related and politically sensitive, the adjustment tends to land on everything else: infrastructure, health, regional transfers, and investment that would normally buy future growth. This is why war spending can inflate GDP numbers while quietly hollowing out productivity. You are consuming the future to pay for present. Official budget planning for 2026 assumes a much friendlier world, something like $59 a barrel and a weaker ruble around the low 90s per dollar. If reality stays closer to current levels, the government either revises plans, draws down the National Wealth Fund, or borrows more. None of these options are free. Borrowing pushes interest costs higher and crowds out private credit. Using the fund reduces the shock absorber for the next crisis. Cutting spending increases domestic friction. And all this happening while the oil market itself reacts to geopolitics, with prices in mid-December trading around $60 a barrel, partly on hopes of peace talks, partly on weak demand signals from China. In other words, Russia's fiscal fate is being decided by variables it does not fully control. And Ukraine's strikes are adding a new variable: reliability risk. And this brings us to the long-term problem, the one people avoid because it is not dramatic like explosion video. The strategic aim is to change Russia's cost curve and to reduce its room for maneuver year after year. Repeated attacks, forced hardening of sites, dispersal of inventories, and heavier defense around industrial belts. Those are costs that do not create new capacity. They just try to keep old capacity alive. At the same time, sanctions make modernization harder. Refineries depend on specialized equipment, catalysts, sensors, and control systems. You can substitute some parts domestically or through third countries, but the repairs become slower, more improvised, and often less efficient. This is how maintenance backlog becomes economic drag. And because Russia has been using spare capacity as buffer, each additional hit eats into the cushion. When cushion is gone, you stop having manageable disruptions and you start having systemic outages that ripple through transport, agriculture, and heating seasons. Now imagine the pressure if shipping rules tighten. If a broader ban on maritime services comes in, Russia must rely even more on older shadow fleet tankers, longer routes, more ship-to-ship transfers, more paperwork games, and more insurance risk. This is not just geopolitics, it is math. Higher logistics cost means larger discounts, and larger discounts mean less tax take. Put this together with a strong ruble and lower prices, and you get a state that must choose between three unpleasant moves: borrow more and pay more interest, drain reserves and lose resilience, or cut civilian spending and accept anger. The tough question is simple. If every barrel brings in less rubles, and every barrel costs more to protect and move, how long can Moscow fund a high-intensity war without cannibalizing the foundations of its own economy? People sometimes ask, will this collapse Russia? I do not think collapse is the right word. More likely is slow tightening, like belt pulled one notch at a time. The state still functions, but it becomes more extractive, more coercive, more dependent on wartime mobilization logic. That is bad for ordinary Russians, and it is also bad for Russia's long-term power, because power comes from investment, technology, and trust, not only from drilling rigs. So when you judge this oil campaign, do not watch only production headlines. Watch export revenue, watch the exchange rate versus the budget assumptions, watch how often key refineries and export nodes get hit, and whether repairs stay fast after repeated strikes. If you see revenue sliding while protection costs rise, then you are watching the war economy being turned into a high-maintenance machine. And the high-maintenance machine, sooner or later, starts to miss payments.